Now, this is the fourth webcast we're doing about the results of 2023. To those that are following us, we will present no big surprises. It was obvious from the start of the year that 2023 was going to be different than 2022. Interest rates were rising during most of the year. Inflation started to decline, but slowly. Global growth weakened, and especially in Europe, growth was minimal. Demand softened gradually in most markets, or remained suppressed in segments where the effects were obvious right from the start of the second half of 2022. Now, under these conditions, our sales volume dropped slightly by 3.7%, just over 560,000 tons, and still well over the 2021 figures, and even growing in key segments. Our adjusted EBITDA was close to 240 million, 11.8% lower than last year, but still 43% higher than 2021. And our net debt to adjusted EBITDA continued to improve to 3.4 times, a marginal improvement, but still reaching towards our target of 3. A major target for 2023 was to reduce net debt, and we managed to improve it by over 140 million to 813 million, and this allows us to be able to propose a dividend of 4 cents per share. Now, to reach this target, we worked on two things. The first was working capital management, and we did quite well there. The second was easier, to slow down investments, and after the startup of our lacquering line at the beginning of the year, our capacity is significantly boosted in order to meet the demand in the aluminum segment. And as we reduced debt, we also reduced our exposure to the interest rates. Only 42% of our debt is exposed to variable rates now. Now, let's see in detail all the main factors that affected our company's performance during the year. First of all, LME prices. LME prices are very important because they affect our turnover. They also affect our working capital. Now, you know that we fully hedge our purchases and sales, so our actual profits are not affected by the fluctuations, but our reported profits are affected. This is a result of the method of valuation, and rising metal prices bring accounting profits, dropping metal prices bring accounting losses. The metals that mostly concern us are copper and aluminum, zinc to a lesser extent. All these metals trended lower during the year, a clear indication of weak global demand. Average prices were much lower for 22 than 22, with no signs of recovering, and aluminum was around 19% lower, copper around 6% lower, and zinc 26% lower. This, of course, helped our working capital, but resulted in accounting metal losses against metal profits for 22 and for 21. Now, let's see at natural gas. Natural gas, this was a positive surprise this year, declining rapidly and much faster in reality than anticipated. There was an uptrend in the second half of the year, especially before the winter. Still, it never went over 50 euro per megawatt hour. And then, when it was obvious that Europe would be well supplied for the winter, it declined again. So we had much more reasonable energy prices for 2023, both on natural gas and on electricity, which is quite related, and still at higher levels than the pre-energy crisis levels. During this period, we renegotiated our contract for our domestic plants with the PPC. Of course, at different market conditions and increased costs. Now, let's see at inflation and how it moved. Lower energy prices helped inflation to continue to decline. Finally, at some point, the central banks stopped increasing interest rates, but still inflation is over the target levels, and the central banks are very cautious about starting to decrease their interest rates. Of course, the consensus is that the decline will start in the middle of 24, and let's see, who knows. As fabricators, and not as primary metals producers, we are not so energy intensive. We use mainly natural gas to melt the metal, and mainly electricity to process it. In ballpark figures, we require around 1,000 gigawatt-hours of natural gas and half around that of electricity. Let's take a look at our 2023 cost breakdown and compare it with 2022. On this pie chart, we exclude the value of the metals since we're passing them on fully to the market, like aluminum, copper, and zinc. As you can see on the chart, energy was around 18% of our total costs in 2022. I remind all that, as we've explained in the past, historically, it ranged to 11 to 13% of our total costs. Transportation costs had risen in 2022. Supply chain disruptions, increased fuel costs, and all that. Now, let's see 2023. In 2023, energy dropped to 17%. In effect, lower natural gas prices were countered by higher electricity prices. Also, as we hedged part of our exposure to natural gas, this had helped us to mitigate the extremely high prices of 2022. On the other hand, the effect was slightly negative in 2023. Supply chains were fine for most of the year, which brought transportation costs down. And of course, inflation affected all other types of expenses, such as employee costs and third-party fees. Our profitability is based mostly on volumes, with a good mix of products, of course, and good conversion prices. Turnover, which is affected by metals prices, is far from being a perfect guide, as metals fluctuate significantly. Let's look at our next slide, which is the volume of sales evolution per quarter. And let's see the first 3 quarters first. We see that in the aluminum segment, these were not very strong, but they were still higher than the respective quarters of 2021. We remind you here that the first quarter also includes a TEM, and the remaining quarters not. Now, in the copper segment, where the drop in demand has started from the middle of 22, we see that we did not reach the 21 quantities in any year, in any quarter. Now, let's see how this year ended. We see that in 22, that both segments had the weakest performance in Q4, in comparison to Q2 21, of course. And this is quite the opposite in 23. It was a relatively strong quarter in terms of volume. Aluminum sales even grew, as the effect of destocking, which was very prominent at the end of 22, seems to have run its course. In general, the fourth quarter brought no big surprises to our overall performance. Now, let's see one of the most important metrics of our profitability, adjusted EBITDA, and how this developed during the year. This slide has a small mistake, of course. It's saying aluminum sales volume and copper sales volume, but you can see on the bottom it's adjusted EBITDA per ton. Again, let's see what's happened in the first 3 quarters. We see that in the aluminum segment, in the first 3 quarters, profitability was down from 22, but still higher than 21 in all quarters. And on copper, it's evident that all quarters were improved, both over 22 and over 21, and despite the lower volumes. Let's see what happened in the last quarters. The aluminum segment had better profitability in the last quarter, surpassing the respective quarter of 22, which was, however, quite weak. The same conditions prevailed during the whole year. Conversion prices for aluminum were relatively steady. Recycling margins, however, were very low. Inflation also worked against us, and what helped us in the last quarter was the stronger volumes. On the other hand, on flexible packaging especially, prices weakened in the last quarter. Now, on the copper segment, performance was strong at the end of the year as well. It was not the best quarter, but it was not the worst as well. As for the whole year, strong prices and good mix helped. We lost quantities of lower value-added products, especially brass rods, and Sofia Med, with a good mix and good prices and good profitability, bolstered the whole segment. Now, one way to measure our performance and also to extrapolate volume growth into profitability is to look at our adjusted EBITDA per ton. Looking first at the aluminum segment, we see that 2022 was an exceptionally strong year. We had not hidden that the jump was not sustainable under the conditions. Our full year results webcast is still online if you want to confirm. In 23, we managed to achieve a healthy figure of 372 euro per ton, which is still stronger than the previous years. In the copper segment, the growth of 22 accelerated in 23. Our consistent strategy with the development of our subsidiary has paid off. Another important metric is the industrial value added per ton. This is the price that we actually charge over our cost of metal. Nominal conversion prices over the LME is the major component. One of the other factors is the recycling margin. This is our ability to increase the value added to our products by utilizing scrap and adding value to it. We have invested significantly in recycling. This is part of our strategy. This is part of our sustainable growth. Now, both segments managed to successfully increase prices in 2022, but in 2023, we will see that the industrial value added of aluminum dropped. Prices remained generally stable in the year. However, scrap margins diminished. This affected our industrial value added and directly our profitability. On the copper segment, scrap spreads were steady. Scrap utilization increased. So did the recycling benefit, of course. Prices remained strong, and the mix of products improved. Notably, more high-value added products from Sofia Med. Now, let's see the distribution of our sales by market. Looking at the revenue breakdown by market, we see that we continue to increase our sales in the aluminum segment for the packaging sector in 2023. This is our strategy and the main target of our recent investments. This segment was also affected by the weak demand. European figures of consumption showed a decline. Consumer disposable income and spending fell. However, we managed to increase our sales. Now, the share of construction shrank even further, partly due to the deconsolidation of ETEM, and all other segments remained at similar levels. In the copper segment, we see that the building and construction segment has declined again. Industrial applications, energy and power networks, this grew. And let's see now the geographical distribution of our sales. Both segments are export-oriented, with Greece being a small part of aluminum sales. We see that this part shrunk this year. This was the result of one major customer reorganizing his production in Europe, and he shut down some production in Greece. Overall, demand in Greece was better, and this helped the copper segment increase slightly this part of the pie. Now, there was a temporary disruption of aluminum sales to the US this spring as a result of the tariffs on Russian aluminum. We ensured that our sales to the USA fully complied, and then sales picked up to the usual levels. And you see that there are no notable changes in the pies other than what I mentioned. Now let's move on to the consolidated key figures slide. We have gone into detail into the volumes and the adjusted EBITDA, but looking at the total figures for the period, we see that they were both higher than 21, but at lower levels than 22. We also said that metal prices declined, so we see that turnover dropped more than volume dropped. Declining metal prices, this translates to metal losses. So we see that on 21 and 22, when metals were rising, we had metal profits. This is an accounting and not a cash effect. We always focus more on our adjusted figures and always stress their importance each and every time. As a result, we see that the EBITDA dropped even further to 176 million euro. And let's look at the next slide, where we see that our EBIT, which was also affected by metal losses, but let's better look at the adjusted EBIT, which was at 166 million, lower than 22, but still much higher than 21. We also see on the finance result that the rising interest rates affected our financial result. Finance costs increased by 27%. This could be higher, but we decreased debt. We had foreseen to make sure that over half of our debt had fixed rates, and actually better rates, and this finally affected our earnings before taxes even further. But it's easy to understand the effects that the metal result has on the earnings before tax. Now let's look at the deviation analysis, and we will see there that the volume loss had a measurable effect on profitability. And we have the price-cost mix side. We have already generally gone through the factors, but let me repeat the highlights. On the minus side, we had lower margins from recycling in aluminum. We also had increased cost, increased electricity cost. We had high inflation. This affected us. On the plus side, we had a better mix in prices, and we had a higher recycling benefit in copper. Now, on SG&A expenses, we see that the deconsolidation of a term reduced the reported costs there. The actual effect was 6.7 million, which means that overall costs did increase, but slightly. Now, rising interest rates affected by our financial costs by 11 million, and the huge difference is the difference in metal result, which turned from profits to losses, and this had the biggest impact of around 109 million euro. Now, let's move on to the cash flows. Our profitability was quite strong this year. Our EBITDA reached 176 million. Interest payments for the period were at 54 million. We always pay our bills on time. And we managed to improve working capital significantly. We released almost 166 million for the period. We will see the details in the next slide. But you know what they say about the two unavoidable things in life. So we paid our taxes of around 20 million. We slowed down our investments. And all this allowed us to decrease our debt, to pay our dividends, and have a bit more cash in the end of the year than in the beginning of the year. Now let's see working capital in more detail. And we can see some very good improvement there. As a percentage of sales, it's down 2 points from 2022, down to 19%, while it was 21%. If we look at it as a net figure, it has improved by 165 million, with the largest part of that being the reduction of inventory by around 127 million. Now, receivables were also slightly better, and we managed to increase our credit terms for suppliers overall. And all these good cash flows allowed us to decrease our debt. We managed a small improvement of our net debt to adjusted EBITDA, and this dropped to 3.4 times from 3.5 times, which was quite close to our long-term target of 3. Let's move on to debt now. As we said, that as we decreased debt, the variable rate debt kept decreasing. Now it's 42% of our total debt. You can see that most of our debt remains long-term, and it's also at favorable fixed rates. On the short term, most of it is long-term, maturing within the next 12 months. We are very well positioned to meet the challenges. Let's see about capex now. As we had said in the past and in the previous presentations, our investments have slowed down. All major investment projects in the aluminum segment are now completed. We have, on the other hand, slightly accelerated our investments in the copper segment. We target to release capacity in Sofia Med in even more value-added products. Our target was not to exceed 100 million, and we kept that target, as we said. To close, despite the volatile business environment, we are confident that our solid positioning and resilient business model will facilitate the agility and responsiveness to market changes. The experience, the expertise of our people, along with our continuous improvement processes, will enable us to align plans to performance, to expand our capabilities, and to navigate any challenges, and to capitalize on the future emerging opportunities. And thank you very much. It's time for the Q&A. Wait, let me check if there are any questions on the web. No questions. Which means that we are doing a good job in order to describe the company's performance and what affects it. I will thank you very much for participating in this webcast, and we are looking forward to an interesting 2024. Thank you very much.